Hello, friends, and welcome back. Friends, you know very well that if you want to create wealth, you are required to invest. You also know that investing in mutual funds is the best way to invest. As in that case, you don't have to track your investments on a daily basis, and your investments are managed by experts called fund managers. You can save your taxes also uh, if you invest in certain mutual funds called as equity linked savings schemes, in short called ELSS. Since we are at the close of the end of the financial year, what better time than now to invest in mutual funds? But since there are hundreds of different mutual funds, question arises which funds you should invest in. Although it is always advisable to take professional help while investing, still we should know some of the things which we should keep in mind while investing in mutual funds and choosing which fund is right for us. We are going to learn in the simplest manner what are different types of funds, what are the different factors like who is the fund manager managing the fund, what is expense ratio for the fund, what is standard deviation and beta of the fund, what is alpha of the fund, and certain other financial ratios like Sharpe ratio, tenures ratio, which you should keep in mind while choosing the best fund for you. So let's begin. Friends, before we start analyzing the mutual funds, let's understand how mutual funds work. So, if you want to invest in company, say Tata Motors, you would buy shares of that company. Now, similar to a company, a mutual fund is also a company. Like Tata Motors is into manufacturing of vehicles, mutual funds are in the business of making investments, and investments by mutual funds are done by experts called fund managers. When an investor buys Tata Motors shares, he is buying partial ownership of the company and its assets. Similarly, a mutual fund investor is buying partial ownership of the mutual fund company and its assets. As I said earlier, if you are making investments in mutual funds, you can either take professional help and make it through a registered authorized person called as distributor, or you can do it by yourself. When you do it through a distributor, it is called a regular scheme. And when you do it through yourself, it is called direct plan. In case of direct plans, returns are slightly higher than regular plans. Now, coming to types of mutual fund schemes can be open-ended schemes or closed-ended schemes. In an open-ended mutual fund, an investor can enter or exit at any point in time, and it does not have a fixed maturity period. On the other hand, closed-ended mutual funds have a fixed maturity date. An investor can only invest in these type of schemes during the initial period known as the new fund offer or NFO period, and his or her investment will automatically be redeemed on the maturity date. Now, all mutual funds allow you to invest in two ways. One is lump sum investments, where you can invest a lump sum amount, and second is systematic investment plan or SIP, where you can invest a small sum on a regular basis. Now, most investors prefer taking SIP route since they can stagger their investment over a period. Investing through an SIP is advisable since it provides the benefit of cost averaging in the long run. A lump sum investment is generally not advisable unless there is a significant chance of making significant gains, like if the market is down and you are sure that the market is going to go up. But the investment advisors always advise against timing of markets. So you should not time the market. So coming to returns from the investment in mutual funds, if you invest in mutual funds, you typically earn a return either through dividends on mutual funds or through capital gains. So the mutual fund basically earns income through receipt of dividends and interest on shares, bond, etc., which the fund invests into. Now, mutual funds in turn distributes this dividend and interest to the unit holders. So this was dividend income. Now, second, when the price of the mutual fund unit called NAV or net asset value increases, you get appreciation in its value, which is called capital appreciation. Now, suppose you say that you don't want a regular income from mutual funds and you want it only when you sell your investments. So when you you get an option. Most of the mutual fund schemes have three options. First is dividend payout, wherein you get the regular dividend. Second is dividend reinvestments, under which although dividends are declared but not paid to you. Instead, dividends are used to buy more units of the same mutual fund scheme, and these additional funds are credited to your account as and when dividend is declared by the mutual fund. Now, third option is the growth option. In case of growth option, the mutual fund, instead of paying dividend, uses the amount to make more investment in the shares or funds. So it increases the assets of the mutual funds. So NAV of your investment increases. So you can go for any of the three options at the time of making investment. So friends, before we go into the details of how to choose the best fund, let's understand what are the different types of funds. Although there are many types of funds, today we are going to discuss the most popular types of mutual funds in India. So mutual funds can invest your amounts either in shares of the companies, or it can invest in interest paying debt instruments. So depending on where the fund invests the money, these funds can be classified as equity funds, debt funds, liquid funds, balanced funds, or hybrid funds, or funds like yield funds and fund of funds. Now, as I said, there could be other types of funds also. Now, first of all, equity funds, which are also called growth scheme. Now, equity funds are one of the most popular mutual fund schemes. They allow investors to participate in stock markets. The equity schemes are categorized as high risk, as these schemes invest majority of the money in equities. But as they say, higher the risk, higher the returns. So these schemes also have a high return potential in the long run. Normally, an equity fund or diversified equity fund, as it is normally called, invest over a range of sectors to distribute the risk. They are mainly ideal for investors in their prime earning stage who are looking to build a portfolio that gives them superior returns over the long term. Now, equity funds further can be sector-specific fund, which invest in specific sectors like the banking, technology, or infrastructure. Equity funds can also be divided based on the segments like large cap, small cap, or mid cap, depending on the market capitalization of the companies in which they invest into. Equity funds can also be index funds. Here, the mutual fund follows the same strategy as the index on which it is based on. So basically, these are replicas of an index and try to achieve returns equivalent to the return of that index. For example, if an index fund if an index fund follows the Nifty index as the replicating index, and if it has a 10% weightage in, let's say, stock A, then that index fund will also invest around 10% of its assets in stock A. Now coming to ELSs. So the equity funds which offer tax benefits to investors are called ELSs. These type of schemes have a 3-year lock-in period. So the investments in the ELSs are eligible for tax deduction under Section 80C of the Income Tax Act. We'll discuss ELSs in detail at a later section of the video. Now coming to fixed income or debt mutual funds. As the name suggests, they invest a majority of the money in debt, means fixed income bearing instruments. These instruments can be government securities or bonds or debentures, etc. The debt funds are low risk, low return funds and are ideal for investors with a low risk appetite and who are looking for generating a steady income. However, they are subject to credit risk. Now, what is credit risk? So a credit risk is the risk of default by the companies in which these mutual funds invest. So that much risk these funds carry. Now, suppose your risk appetite is moderate, means you don't want to take high risk, but at the same time, you don't want penny returns also. So coming to balance funds, As the name suggests, these are mutual fund schemes that divide their investments between equity and debt. The allocation between equity and debt may keep changing based on the market risk. As I said, they are more suitable for investors who are looking for a combination of moderate returns with comparatively low risk. Now, next is hybrid funds. Hybrid funds are similar to balanced funds, but the proportion of equity assets is lesser compared to balanced funds. Now, coming to money market funds or liquid funds. Now, suppose you have certain funds which are lying in your bank account, which you have to invest somewhere, but not now, after a certain period. So now these funds are lying idle. You want to invest these funds for a short period so that you can earn more than your saving account pays you. At the same time, you don't want to take much risk. So in that case, you can invest these amounts in something called liquid funds. So money market funds or liquid funds invest in short-term debt instruments which can give a reasonable return to investors over a short period of time. As I said, these funds are suitable for investors with a low risk appetite and who are looking at parking their surplus funds over a short term. Now, coming to gilt funds. Now, gilt funds are also kind of liquid funds which invest only in government securities. Now, as the government securities are said to be least risky, so they are ideal for investors who are risk averse and want no credit risk associated with their investment. However, since investments in government securities are generally for longer durations, they are subject to high interest rate risk. High interest rate risk means the risk of fluctuating interest rates. So if the interest rate rise, NAV of these funds go down, and when the interest rates falls, the value of these funds rise. So in a falling interest rate regime, these funds can give a much better return. In fact, if the economic slumps, these funds can give even better returns than equity funds. Now coming to fund of funds. So as the name suggests, these funds invest in other funds. So similar to balanced funds, they try to make asset allocation and diversification easier for the investor. The expense ratio for fund of funds is generally higher than standalone mutual funds. Now you would be thinking, what is expense ratio? So expense ratio is the combined cost of managing a fund, including its operating expenses, divided by the total assets of the funds. So in case of fund of funds, since the expenses are at two levels, first at the level of the fund in which you invest, and the second at the level of funds in which the fund invests. So expense ratio is generally higher. Now, in case of funds like index funds, the expense ratio is relatively low. Now, before going further, as I said, we'll discuss ELSS in detail. So, equity-linked saving scheme, commonly referred to as the tax-saving funds, fall under the diversified category of mutual funds. While the maximum exposure is towards equity, a part of the corpus is also invested in debt instruments. Now, ELSS is covered under Section 80C of the Income Tax Act, under which you can claim deductions for up to rupees 1,50,000 of investments, and this can help you save up to rupees 46,800 a year in taxes, depending on in which tax rate slab you fall into. Now, if your annual income is more than rupees 50 lakhs, the tax savings can be higher, and it is applicable only to individual and HUF. But these funds come with a mandatory lock-in period of 3 years. But still, considering that all ATC investment options have lock-in period, ELSS has the shortest lock-in period among all ATC options. However, these funds are suitable only for those who are willing to take some risk and can stay invested for at least the mandatory lock-in period of 3 years. However, when I say tax benefits, you get the tax deduction in the year in which you make investments. But returns from ELSS are not tax exempt. Since ELSS mutual funds are a class of equity funds, they are also taxed like an equity fund. So earlier, dividends were made tax-free in the hands of investors as the fund house was supposed to pay dividend distribution tax. But from financial year 2020-21 onwards, any dividends offered by these funds are added to your income and taxed as per your income tax slab. Now, coming to capital gains, since there is a mandatory lock-in period of 3 years, there is no question of short-term capital gains. As far as long-term capital gain is concerned, the long-term capital gain of up to rupees 1 lakh a year are tax exempt. Any long-term gains exceeding rupees 1 lakh are taxed at the rate of 10% without any indexation benefit. Now, similar to other mutual fund schemes, instead of lump sum, you can invest in SIP also in ELSS. Now, coming to the main question, with so many different types of mutual funds available in the market, how to choose the best fund that suit your specific needs? The answer is simple. First of all, you have to identify your needs and goals. Your needs could be to buy a new house. It could be higher education for your kids. Could be marriage of your kids, or to buy a car, or it could be for your retirement planning. It can also be for earning a regular income or just to save tax. So now the next step is the time frame within which you want to achieve these goals. Is it to build wealth quickly, at a moderate pace, or at a slow pace? Now, once that is decided, the last main thing to consider is the risk you are willing to take. As you know, mutual funds are influenced by market movements. Therefore, investors must be willing to assume these risks by investing in mutual funds. So, assessing your risk profile is a must. The highest returns are generally observed to come from the funds offering the highest risk. So, if you want returns quickly and are willing to take risk, then that is the fund to go for. If your objective is to build wealth slowly, then going for a medium or low risk mutual fund is ideal. A lot will also depend on your age. Now, since mutual funds always come with a factor of risk associated with them, no matter how small it is imperative that investors read their policy documents carefully before investing. It would also be a good idea to read the document to ensure that you have understood exactly what you are investing in. So friends, today we have learned what are the different types of funds and on what basis you should choose a particular category of fund. Depending on your goals, needs, and risk profile, once you decide which type or category of mutual funds you have to invest, the next question arises is which funds to choose from within a particular category. As there could be hundreds of different funds houses in a particular category. So in the next part of the video, we'll learn some of the most important aspects which you can look into while filtering out the best funds. Till then, bye and take care.